Good evening, and thank you all for joining us tonight. Stay tuned for Smart Money Moves with financial planner Tiffany Tippins coming up here shortly.
Good evening. My name is Tiffany Tippins, and you are tuning into Smart Money Moves with your host and financial planner, myself, Tiffany Tippins. We're going to be talking about preparing your student for college. If you have tuned in on Heaven 97 KHVN here in Dallas, Texas, over the last couple of weeks, we have been talking about how to save for college. And just yesterday, on Saturday, we talked about preparing your college student to handle their personal finances for college. So today we're going to go over those two shows. We should be about 45 minutes to an hour on the show, but we are going to wrap up at the end and open up for any questions. If you have any questions, please save them for the end of the show, and you can call the studio hotline at 240-455-5934. Again, that number is 240-455-5934. So how I began my show is I really love streaming the show, and it's very helpful because I'm going to be jumping from a presentation to the internet to kind of show you some tools and resources on how to save for college and different instruments, how you can save. So I'm going to go ahead and share my screen, jump into a presentation that I have for you, and then we will get started. Okay, so we are looking at the college savings and you by Oppenheimer funds. If you all don't know, I have been a financial advisor going on since 2004. I have been licensed for the last 12 years. But prior to that, I had been managing retirement plans in 1999. So I guess that makes it about 17 years working with different retirement plans for individuals and small businesses and corporations. And Oppenheimer funds has been around for years. I've been using them in my clients' portfolios, and they have a great presentation and a great plan on how to save for financial plans for students or college savings plans. So let's jump into their presentation. There's a couple of things that we're going to go over. Obviously, how to save for college, the advantages of 529 plans. I'm also going to jump from the presentation and talk about life insurance for kids and how to save through life insurance as well. And then we're going to jump into the second part of the presentation on if your student is getting ready to go to college, which means we've been doing this back to school series. As I stated earlier, if they are getting ready to be a freshman on college campus, whether it's local or out of state, I definitely want to share some thoughts with you on how they can handle their personal finances in a more comprehensive way. So make sure you get out a pad to write on, get a pen. You'll definitely want to take notes. So the value of college and the value of a college degree. This is a personal decision for everyone. Obviously, those of you who have attended college, possibly you definitely see the difference. And here, research shows that there's a difference of annual median family income when it comes to having a college degree versus not having one, or even having some college. And so you'll see here, and this survey was done a few years back, where it listed if you had a high school diploma, your source of income or your median income for those who just had a high school diploma was around $48,000. exactly $48,637. However, if you had some college, possibly you went to junior college and you spent 1 or 2 years in college, you'll have a little higher income, which was about 58,258. But a bachelor's degree would have a higher income. Now, these incomes have changed with a number of things that you want to factor in. It varies on the state you live in. It also varies on the type of specialty or work that you do. But for the most part, it shows having a bachelor's degree or a higher degree, such as a master's or doctorate, you're going to have a chance to have a higher income versus someone who has a high school diploma or some college. And so, again, for those of you who think college is worth it, you have to look at what you're going to be spending in college versus what you plan to make in the real world, and what college is going to cost you for a 4-year college education. Also, families want to think about how much or where they're going to college. If they're going to a private institution or a public institution, that can make a biggest difference in the world on where you're going to go. I went to a private HBCU, Hampton University, and it made a very big difference on how much my education was when I went to school versus what it is today. And versus what a public institution would charge for tuition. Major difference. It also makes a difference if I was a resident of Virginia, where Hampton University is located, versus being a non-resident. So it really didn't matter because Hampton is a private institution. So there was no in-state or out-of-state tuition. Everybody paid the same rates. Still is the same type of tuition today, but there are public state schools, like I'm in Texas right now. So University of Arlington at Texas is a public institution, and so that is going to be a difference for someone who's coming out of state. Let's say Virginia or DC, their tuition is going to be different versus somebody who is in the state of Texas. And we'll talk about that in a few minutes of how to kind of gauge where you want to go to school. Education costs outpace inflation, and I can definitely speak from this on a personal level. Here again, the statistics are coming from the College Board in 2010 on the pricing of education. And so again, I talked about private versus public institutions. You can see here from 2011 to 2010 to 2011, a public institution would have cost $87,664 versus a private institution almost double that amount, a little bit more than double that amount at $174,000, 457. And so that's over a four-year time frame. You would factor those costs. Again, now you look at between 2019 and 2020 for a 4-year institution, public versus private, you see the major difference. Now you're factoring in 2028, so that's people, children who are being born now, 210,000, almost 211 versus 419, almost 420 for a private institution. Definitely is out factoring or outweighing inflation, because inflation is only an average of 2.5% to 3% a year. So you can see from 2010 to 2011, even for what the cost of tuition is today. 2019 is right around the corner. That's just in 3 years. So that should show you about how much you need to be saving. Generally, it is assumed at a 6% interest rate that the cost for college goes up, almost double that of what what inflation increases. Just to give you another real life example, when I went to Hampton in 1994, it was 6,000 per semester, so about 12,000 for the year. Now Hampton is over 30,000 a year. And that has been 18 years ago. So you can just, again, see the cost of inflation. If you're thinking about sending your child to school, you definitely want to start saving now. How to maximize your savings? Well, one, the money you start saving today can grow over time, potentially creating more money for a higher education and higher education expenses in the future. So I always let people know it doesn't take a whole lot to start saving. We're going to talk about the 529 plan advantages, saving advantages now, but literally it could take $25, $50 a month, $75 a month, and you can get various people to save with you. So let's jump right in with the advantages. The 529 plan mirrors close to what you may know at work as your 401k or 403b plan. So it's a specific savings for education. Unlike your 401k or your 403b plan, you're saving for retirement. However, the major difference is with this plan, even though with your 401k plan, your 403b, your account balances grow over time faster than taxable investments. The major difference is your qualified withdrawals are federal tax free. So federally, you're not paying any tax on the actual income that you're taking out for this particular plan, which is saving for college. So the tax advantage and the taxable savings account, you'll see with the taxable savings account, you saving on your own, possibly through a checking account or a savings account, or even some bonds. That money is going to be taxed. You look from 1 to 18 years before your child goes to college. However, with a tax advantage plan, you're going to save more money. In this illustration, you can easily see you're saving about $6,000 more, because once you take the money out for qualified educational expenses, you will not be taxed on the federal rate. Non-qualified withdrawals, which means withdrawals or money not used towards education, is going to incur a 10% penalty, and you're going to have to pay your state income tax. So that's something that you want to think about. And this hypothetical illustration assumes an investment of $10,000 and a 5% annual return. Getting a 5% annual return is generally pretty low. That's on an average. Again, the younger your child is, possibly the more you want to start with more aggressive investments, just as you would if you're just starting out in your job and you're saving for your retirement plan. You want to be more aggressive the younger your child is as well. The closer you get towards them entering college, you want to kind of scale back on those investments. Again, similar to what you would do with a 401k or 403b plan, because you're getting ready to use that money. So you don't want them with so many risky investments in their portfolio. Here's another example of compounding interest on the money that you save. $150 monthly deduction versus $250 versus $500 over 18 years. Again, assuming an interest rate of 5% with no fluctuation in principal. Now, we know that that's not going to happen. That's why this is a hypothetical illustration. The money is put into mutual funds, so the market, you're going to see a fluctuation in the market. However, just as the market does well, there are going to be some times of low return in the market. However, as I've stated over and over again, the market always outpaces inflation when it comes to looking at putting your money in investments that grow over time. Stocks and bonds always outpace regular checking and savings and bonds. So you want to look at putting your money into mutual funds and possibly stock as well if you're comfortable with that. Here's some other advantages when it comes to estate planning and the benefits and advantages of planning for 529 plan. One, it reduces the estate tax. Contributions are considered completed gifts excluded from contributors' taxable estate. And so with this, the exclusion or gifting for a 529 plan is $14,000. So someone can put $14,000 into your plan and deduct that as an exclusion. Again, there can be a lump sum contribution. There's no income level restrictions or age limitations for 529 plans. You can have as many accounts as you want. Anyone, including family and friends, can contribute to the account. So parents, grandparents, relatives, or friends, but only account owners may direct transfers and rollovers. So if you're the parent putting money into this account, you're the account owner, and you can be the only one who is responsible or in charge of directing any transfers or rollovers. You're also the only one that can make any investment changes or withdrawals, and the designated beneficiary changes. And the account can even set up an account for yourself, so you can be the beneficiary for the account yourself. Again, only if the money is used for higher education. So if you designated this to a child, and we know the child might be 2 right now and they're not sure what they want to do when they become of age or graduate from school, you can definitely change the beneficiaries on this. You can be the beneficiary only if it's for higher education, bachelor's degree, 2-year universities, or master's or doctorate, higher education. These accounts are not used for private tuition for grade school level. So again, higher education where these accounts can be used for. And as an account owner, you maintain control over the assets. You select and change the beneficiary at any time. Again, you make the qualified withdrawals or non-qualified. Just know that if you pulled money out for any reason other than higher education expenses, you will get that 10% penalty. So the flexibility that you have with the plan is you can use it at any accredited public or private post-secondary institution. Again, I said a 2 or 4-year undergraduate programs. Vocational and technical schools are considered as an option as well. If someone's going to cooking school or a vocational school that teaches mechanics, this definitely can be geared towards those institutions. Also, graduate, professional, medical, and law schools apply as well. And it covers things like tuition and fees, room and board, books and supplies, special equipment that you need. I've seen also 529 plans being used for public transportation back and home from college during break. So there's a variety of options that you can use for 529 plans, and there's a long list of qualified educational expenses on the IRS's website. So here's just comparing some higher education savings options. 529 plans is one option. Again, any earnings grow tax free. You have a higher contribution limit to these plans. The owner has control over the assets. They can change the beneficiary anytime. Estate and gifting benefits are available. Again, aunts, uncles, friends can contribute towards this plan on a monthly basis or an annual basis. You have 14,000 of exclusions of gift tax. I've seen this where grandparents have donated money to reduce their taxable income. And the low weighting in federal and financial aid calculations help you. There are no income restrictions. Versus a Coverdale educational IRA, you can only contribute up to $2,000 for this account. And there will be some income restrictions on these accounts. With Section 529 prepaid plans, no investment control. So these plans are generally the control of the state. And we're going to switch off to another website that I'm going to show you in a few minutes on comparing 529 plans. The funds may not be transferable to out-of-state schools, so that's definitely an advantage. If your child changes their mind, or if you have some decision on where they go to school, this could be a disadvantage for you. And then the UGMA or UTMA accounts, minors gain control of these accounts at certain ages and can be used assets for any purpose. Earnings are taxable. Again, on these accounts, unlike the 529 plans, they're not taxable. And there's a higher weighting in financial aid calculations, treating the student's assets. So if the student has more than 20% of assets, this might not be the right account for you. So there's a multi-manager approach, offers expertise from industries across the asset classes. I'm a financial planner licensed in 6 different states on investments, on insurance, 13 different states. Definitely you can reach out to me and give me a call at 800-408-8850, and I can give you some feedback based on your particular situation, what might be the best portfolio for your child depending on their age and your investment goals. And contributions, as we can see here, can start as little as $15 a month. So these are just some investment approaches. Again, the earlier you start, probably the more aggressive you're going to be. And then as your child gets older and they're approaching college, they're probably going to be in more conservative or fixed income portfolios. These also give you some age-based investment selections based on your age. So again, ages 0 to 6, they're going to have 90% of their portfolio in equities and 10% in bonds. Again, the older they get, that equity position is going to be cut down to 70%. And age-based from 10 to 11, 60, again, mirrors very much like a retirement portfolio. The younger someone is, the more aggressive they're going to be. However, the closer they approach retirement, the more conservative they're going to be. And here's the age base at 18 years, what a portfolio looks like there. They're going to have about 75% of their money in equities, 10% in bonds, and some in money markets that offer stability. So that'll just be like a savings account. So to start sooner rather than later, you definitely want to help maximize your contributions. There's always times that you can contribute to this plan. Birthdays, any where you are offering, I hear some feedback, guys. So birthdays, anytime your child gets some good grades, and we know that you exchange money for grades, that's a great time for you to put some money. Any special gifts, any special celebrations, time for this to go into a 529 plan. Or you can also just set this up as a monthly plan where you're putting 50 to 75 to $100 in on a regular basis. So next steps, if you have any steps or any questions on setting up these 529 plans, you can contact my office, 800-408-8850. Again, 800-408-8850. Now we're just going to jump into my screen where a website that I really, really like and want to show you on how to save and how to select these different college plans on savingforcollege.com. So let me bring you there. I have maybe lost my site. No. Here we go. This is a great site, savingforcollege.com. It gives you a history of the 529 plan, how it was created in the IRS code in 1996. There's a whole host of tools and research on this that I want to walk you through. So one, you can look at under 529 tab, you can look at your state plan, and you can also compare other 529 plans. I just mentioned I attended school in the state of Virginia, but I grew up in Michigan. And so let's just say, for instance, my parents set up a 529 plan and they set up a 529 state plan for me. That means that the plan that they would have set up for me would have only been for the state of Michigan. And I actually at one point got accepted and thought about going to Michigan State, but I changed my mind and went to Hampton. That plan probably would have been no good for me because I went out of state. The state plan definitely can help with saving on state tuition. However, if you go out of state, you may lose some control on that. And again, with the 529 plan, as we showed the comparisons, you have no control over the investments. So you really want to look at, is it something generational that your family has attended a certain college in your particular state and you want them to go to that state? Is it going to be a state school or is it going to be a private school? Those are some things that you want to look at. When you can also compare 529 plans as well. And what I love about savingforcollege.com, there's all types of 529 plans. There's direct sold 529 programs, and then there's broker sold savings plans. So the broker sold savings plans, you would go through a financial advisor like myself. And we offer a variety of companies as well. or you can go directly to the investment company who offers the 529 plans and create a account with them. However, there is no investment professional handling the direct sold savings plan. So if you feel like you're investment savvy and you want to manage this plan yourself, definitely you can go to the direct sold savings programs. But the best option would be to go to the brokered sold savings program. There are also prepaid plans, and under prepaid plans, that's basically you are capturing the rate of um, the tuition by prepaying for education covering 1 to 5 years of tuition, either in a lump sum or installment basis. Again, you really need to make sure that your child will be going in state or to a particular school for these programs. I just know a lot of kids at the last minute, they have no idea where they want to go, generally within a year to 2 years before going to college. And so as you save for these plans, if you're saving over 18 years, it's going to be a lot of money that you saved where you probably will not be able to use that money for that particular school. So you want to make sure that you select a plan that's flexible. This is definitely the site where you want to read up the difference between prepaid plans, savings plans, the UGMA accounts. They will definitely tell you what, or give you some ideas, what are the best. We went over the 529, the Coverdale educational savings account. You can compare the savings options here. Again, a great site that you want to go over. Also, some great tools and calculators. This will give you an idea of kind of how to factor in your financial aid, how much college will cost. And I'm just going to do a simple illustration. I'm going to do it after my godchild, who just turned 5. So it says the simplest way to estimate college. How old is your child? So let's put in her age. And then it's basically telling me that if my goal is to cover 100% of the projected cost for college, that's about how much I would have to pay for her, or we'd have to pay for her projected cost. Or I could start making monthly payments of this to meet my goal. So I can say, she'll be attending the college that currently costs $25,000 a year. She has 13 years until she attends college. She's going to a 4-year university. Wish to save enough to pay for a 100%. But let's just say, you know what? I don't want to cover 100% of her costs. And maybe her college, at the college she wants to go to now, is not $25,000. Let's say I want her to go to my alma mater. So I will put about $33,000 in. She'll be attending college for 4 years on a full-time basis. But I only want to, as her godmother, want to save 25%. Okay, of her income. Yes, I want to make my monthly contributions. We have to factor in inflation, and so it's going to give me a new report. So now it's saying I need to put almost $200 a month in to help her save, and this is what her projected cost would be for 4 years of college. So as her godmother, I would do my part by putting in about $200 a month for her. Obviously, we can change that again she's in Florida. Let's say she's going to state school, and her state school doesn't cost that much. And so I can recalculate that. And so these tools really give you a good idea of about how much you need to be saving for your child, depending on what type of goal you have. Are you covering 100% of the goal, or are you covering a portion of the goal? So I changed that again and said, you know what, she'll probably go in-state in Florida where they live. This is how much her annual cost is right now at one of the schools. Or this actually will allow me to pick a school, and I could just start putting in how much a school would cost. So let me, I'm going to put in her mother's alma mater, FAMU. So FAMU right now on campus is going to cost her this. So I was about close to where her mom's alma mater is, and I still want to do 25%, and so the other 75% needs to come either from her parents, student loans, or grants and scholarship. Hopefully she can make this much up with a lot of it up with scholarships and grants instead of taking loans. So this would be my monthly portion. Okay, and the great thing about this with 529 plans, you can add anybody in this. So if I wanted to add somebody else, another family member in it, and say we cut the cost, this is what we need to be doing in order to be saving this monthly amount for my goddaughter to reach her goal of attending college and have her college fully paid for over the next 4 years once she becomes 18 and 13 years. Great website to go over. Again, it gives you a host of information of where you can get ready for college, planning for financial aid, and scholarships. There's also other webcasts on this site, as well as other super funding calculators that you can get into, especially when you look at the portfolio that you want your child in to this account. So that is the 529 plan series that I wanted to go over today. Just a couple things that I wanted to go over. I'm going to stop sharing my screen right now. Just a couple things I wanted to go over to talk to those who are looking to go to college at this time. And so one of those things is, if you are at the point that you're getting ready to step on campus, here's a couple things I would like you to do. Number one, set a budget. You definitely want to set a budget on how much it's going to cost you out of pocket, whether it's scholarships, whether it's financial aid, whether it's student loan, whatever income that your student has coming in. You want to make sure that they set a budget, because this is the first time that they're going to be on their own, away from home, planning in college. And so this is the time that they need to handle their personal finances. Housing is probably going to be one of the biggest ones, whether they're a freshman or upperclassman. Possibly this year they're staying off campus. Definitely you want to factor in that housing cost to what other income that they're getting to be supported in college. Food. Remember the freshman 15, we ate crazy in college. Want to set a budget on how much eating out, or how much they're cooking at home, or how much what are their meal plan for the cafeteria on campus. Also, transportation. I remember having a car on campus, not the first year, but the first year I went back and forth home. And so generally I just went home for the breaks, where other people who lived a little bit closer to the university went home more often. And so you have to think about how much is it costing in gas, train, plane, for them to get back and forth home during their time at the university when they take breaks. And of course, when they come home, you have to factor that in as well. And so some other ancillary, definitely books. Books are very expensive in college. They don't necessarily need the newest book, and so you want to look at purchasing, cutting your cost on exchanging books, talking to other students, getting the same book for a lower price, because I can definitely tell you that one book might be $200, but that same version, that same edition from somebody else might be $100. So you definitely want to look at ways of cutting costs. The other thing you want to look at is this is the first time as well that they will be starting to create a credit file for them. And so with students taking loans, you want to make sure that they check their credit report. So I'm going to share my screen one more time, go over to myfico.com, and show you how to check your credit report. Remember, I'll actually go to annualcreditreport.com first. Remember, because they are establishing credit, they definitely want to check your credit just like you or me, and make sure that what they are applying for is on their credit report and that they are not a victim of credit theft. So on annualcreditreport.com, you can start by getting a free credit report from each of these three bureaus: Experian, TransUnion, and Equifax. The reports are free. You get a free copy every 12 months from each credit report, and I suggest you stagger them. And so instead of ordering all your reports at once, order Experian possibly in January, TransUnion in the middle of the year, and Equifax in the fall. Or you may want to mix them up, but just stagger the reports. You want to make sure you check all three of your child's reports, because every lender does not report to every bureau. So I believe the student loan companies report to all, but it's not a federal law that every lender has to report. Your credit score is not free. That is something that you have to pay for. Your report is free. Another place you can go to check your report and your score is myfico.com. So myfico.com is an awesome way to kind of gauge your report. There's all types of learning tools where you can get information, the best credit cards. I really like this one because it tells you, based on your score, if it's going to be bad, fair, good, or excellent. For students, it also gives a recommendation of, what's the best credit card. We know with this Journey Student Rewards from Capital One, there's no for purchases intro to APR. It's pretty low, but they need average or fair credit. There's no annual fee here. For some of the other credit cards, there may be fees or annual fees every year. You can also go to Chase and Bank of America, American Express. They're also known for having good credit cards that are specifically for students. Here you can learn so much about your score, how your score is made up. Again, our kids really need to be learning this information. Unlike the time that I was in school, we used to have lenders coming on campus all the time, giving us free t-shirts to sign up for a credit card. That is no longer the case. And a lot of campuses has reduced the invites of credit card companies. Number one, a law was implemented in 2013 that was prohibited. You have to be at least 21 in order to get credit. So to open up a credit card, an unsecured credit card. So an unsecured credit card means it is not attached to any checking account or savings account. However, if your child is under 21, they can start with a secured credit card, which you can simply do at your bank, and that's attached to a savings or a checking account. And essentially, if you're putting $500 into that account, that's how much credit they have. It basically looks at how they use it over a certain time and what they're replenishing the account with, or what you're replenishing the account with. So you may, for someone who's under 18 or under 21, look at establishing a secure credit card versus a unsecured credit card. Here it also tells you how your score is made up. Great video. I went over it last week, but just wanted to reference it again for you to go over with your student as well. Some other things that you want to be thinking about as well is, I know, we looked at the cost of education and how expensive it can be. And some things that you might want to think about is maybe not starting out off at a 4-year university. You may want to start off at a 2-year university. So in the first year, you're taking general classes anyway. Math, basic science, English. You can definitely get those classes from a 1 or 2 year university and transfer those credits over. Same degree after 4 years. You've just spent a year or two less on campus. So definitely you want to possibly think with cutting costs, maybe going to a 2-year university, possibly for a year or two, before sending your child onto a 4-year university. I know a lot of people don't want to do that, but I know a lot of students are doing that today, and it definitely helps on cutting down costs. One other thing, don't forget, continue to get scholarships. They're always out there. That's what the alumni is for, which is a great way for you to apply. And I see a lot of students that don't apply for scholarships, especially in years after their freshman year. They feel like, oh, I got in and I'll just take loans. No, I mean, you definitely need to be applying for scholarships, whether they're at church, fraternities and sororities, nonprofits. Yesterday, I just Googled coding for minorities, and it came up scholarships through Facebook, through the Point Foundation, through GeekWire. So scholarships are out here. You just need to apply for them and seek them. There's so much money that's going unrewarded when it comes to scholarships. And as they matriculate in their time in college and they get more into their field of study, that's when you definitely want to be applying for these corporations, because that's going to identify the work that they should be doing. So such as interning, you definitely want to make sure that they're applying for scholarships in that area. And last but not least, you also want to make sure that when you are looking to co-sign for them, such as housing and getting a car, that they have learned to manage credit, that they're paying their payments on time. Again, more than 30 days, it's going to get a mark on their credit report. So if they're just a couple days late, generally a lender is not going to report for that. But more than 30 days, especially for somebody who is just starting credit, it's going to be detrimental to their score. So you want to make sure that if you're co-signing for your child, that they have picked up some smart financial habits and making sure that they pay their bills on time. Again, you have been tuning into Smart Money Moves with your host, financial planner Tiffany Tippins. We have been talking on our back to school series on college planning and the different avenues of preparing your students for college, whether they are babies now or they're approaching now. 529 plans are a great asset to start planning. One other thing that I did not mention is life insurance. Life insurance has no particular age requirements on, especially if you are looking to purchase a permanent policy, and that's the only one that I would recommend, either whole life or universal or variable universal life. You can take that money out and use those funds for anything, especially for college. Now, what you pay for the policy is not taxable, but any interest on the money that is accrued in the account is non-taxable. So you want to make sure that you also look at life insurance as a financial planning tool for students as well. And then finally, we talked about how to prep your students for college, going away, making sure that they're setting a budget, making sure that they're checking their credit, and if you're co-signing for them, that they're paying their bills on time. Again, we want to create a smarter generation, and that only starts with teaching them how to be more fiscally responsible when it comes to handling their personal finances. Thank you for tuning in for another great show of Smart Money Moves, and until next time, be blessed.
Gonna be trouble. Trouble.